FIIs. Let's move on in time now for the big call from Amundi. Head of Asia Investment Florian Neto says that the money will soon dial out of the US. Shedding light on the global picture, says that the greenback has already started to weaken. But what does this mean for the emerging markets such as ours? How does India shake up amid all the tariff-led uncertainty? And do Indian equities warrant more FII attention? Answers to all this and lots more. Take a look.
On the US dollar depreciating, it's happening already, but not versus rupiah or versus some emerging currency, but it's happening already versus yen, versus euro. You may see that the euro has been moving 5% already, appreciating. The yen as well have been moving 10% over the last 3 months. So the dollar has been depreciating in trade weighting terms, but not versus some specific EM currencies. Second point, we are strong believer, and it's part of our outlook for this year, that the US performance, the design of it, was not sustainable. It was too concentrated, lower breadth, and indeed those stocks, those Max 7 stocks, deserve to perform well because they have been having strong guidance, strong earnings, high bar, and they have been matching the bar or exceeding the bar. But we do believe now that the S&P will perform less than other markets, because S&P the performance should broaden to other stocks and other sectors. And we do see as well flows moving out of the US and into other areas where they can find more valuation appealing stories there.
So we'll get this flash out. The head of investment Asia for Amundi, Florian, feels that US markets have peaked out in the probability of money moving out of US, according to US, higher in next coming days or in coming months. That's first story.
We believe the S&P can still go up, but not with the leadership of the Max 7.
Great. So US tech stocks, as we famously call them, the so-called famous 7, famous 5.
We are very selective on them.
You're very selective on them. Okay.
Yeah.
Out of the $2.2 billion which you manage, where are you right now overweight and where are you right now underweight at a global level?
At a global level, we have another weight on European equities, we have another weight on India equities, and we have now a tactical overweight on China equities. So this is how we are rebalancing a bit our overweight of the US that we have been having for a long time, and we are coming back neutral on the US. Then on the fixed income side, we are positive on duration, and we have been positive on duration. Today, on the curve in the US, we do feel that a lot is priced in. We have 3 cuts in our central scenario. We are now priced in for 3 cuts, and we do think that the US growth scare is temporary. We do think that the US growth will still be there and they will deliver 2% for this year. So we tend to tactically reduce our duration today from a high level. We are taking some profits from the recent growth scare that is priced on the fixed income markets. And we remain very positive on credit, on IG credit. Even if you don't have a lot to make there, we're still positive because we don't think the issue in terms of leverage and into issue in terms of profitability. So as soon as the Fed may stop there and cut sporadically going forward, but the financial condition will keep on being a bit more accommodative, especially if we have in mind that the dollar will be depreciating a bit along the road. So it's still a carry and credit environment in our view.
You know, you're already my best friend because you've said that you've increased your overweight on India. What was your overweight positioning? What was your positioning, let's say, about a year ago in India? And where is it now? And why have you changed it?
So I think it depends on which fund you're talking to. If you go globally, the allocation to India will be rather small because globally, if you look into global indexes, India portion is small from a market capitalization point of view. But at the same time, if you look only at market capitalization, then you miss a lot of opportunities. Typically, within emerging markets, over the recent 2 years, to have good performance, you need to have India and you need to have Taiwan. And China has been costly. So the thing is, we have been reducing our allocation, our overweight to India, if you look at 1 year ago compared to now. India is a structural story for us. So it's the only place in Asia where you find so many companies able to deliver growth. So when you have a forward ROE of 15+%, you don't have a lot of areas when you'll be able to have that. Then the concern from investors was from the valuation perspective and the earning trajectory. And this is the earning trajectory for us that has been eventually leading us to reduce our overweight. Why? Because when you have earning revision ratios that are going down, And it's basically due to macro factors domestically, but as well external factors. The domestically, frankly, we are seeing positively the fact that there is fiscal consolidation in India. We do think this is a short-term pain to have a more structural growth story going forward. But over the very short term, it means that it's a bit more complicated for companies to deliver earnings. The second point is on CapEx. On CapEx in India, we have not seen private CapEx taking the baton, and we have seen consumption very strong. So this is a missing point where we have been saying, okay, let's take a bit some profit out and see if there are other opportunities where we are underweight in areas, and it was allocating a bit more to that.
Since you just mentioned at the beginning of your answer that you were underweight India, now you are started coming back to India. Can you explain that point?
No, we have been overweight India and reducing the overweight on India. And tactically, we do feel now that large cap, after the recent, you mentioned initially in your introduction, India performance year to date, Nifty -5. MSCI China, +20. You have 25% performance differential in the matter of 8 weeks only. So it's substantial. We've seen outflows, you were mentioning about it. We saw 20 billion roughly of foreign investors selling India equities since the beginning of the year. They are reallocating into other areas. Okay. But at the same time, our strong conviction is the valuation, the ratings that we have seen has been stronger than the lower earnings delivery.
The Indian valuation derating is higher than the actual slowdown in the earnings.
Yes,
that's a great point.
In our view, yes.
So have you been a net buyer in Indian equities in last 6 weeks or last 8 weeks?
Last week.
Okay.
We have been coming back to it. And on the large cap, we do feel that the valuations that we are seeing on mid cap is still a bit expensive compared to what we are seeing from an earning revision ratio on the market. Of course, you can selectively find some stocks, but in general, we do feel that now on the large cap, most of the resit on the valuation has been happening already.
Could you go back to your original commitment to India in terms of the total exposure you had at country level? Do you see that going back to that level?
I think step by step it will be the case. One of the contingency is how the Chinese rally is evolving. Because the Chinese rally is a tactical rally for now, in our view, but it can become more sustainable. So the question is on the leadership. And we do feel okay having an overweight on India and an overweight on China today in our portfolio. The overweight on China is not sustainable yet, and earnings there is not good enough yet. So there is good prospect for Chinese companies to deliver more because the business environment is evolving. Because when you see some very strong platform, technology platform earnings, high guidance, strong capex over the next 3 years. So you see good commitment, but we need to see more of that to make it a bit more sustainable.
Okay. So again, I'll take the liberty of just summarizing our interview as we keep on going. Our first point, you said that, look, US markets, according to you, they had become Humpty Dumpty, and now they're losing some weight. But when money is moving out of US equities and US bond market and the dollar, it is moving back into emerging markets. As of now, the tactical trade is China, and India is more like a structural trade where you were not excited about a year ago, but you've come back in last 6 weeks and you expect that you're going to be here for next couple of weeks if earnings they continue to pick up. My next question about India is that you look at Indian earnings and then you look at the sectoral breakup as well. What within India you like in terms of themes and sectors where you overweight and when you are underweight?
What we have been adding recently, and we are more convinced on, is on the bank side, on the hospitals, for example, on the healthcare, and we have been adding as well some platform food delivery, for example. And those actually have been having a last quarterly earnings upside surprise. We didn't have a lot of upside surprise in the earnings in India, but I would say the previous quarters were disappointing. The last quarter is showing more strength. Not yet what we have been used to, because we have been used to very strong earnings in India, but we feel that it's coming back. And it's as well linked to the fact that consumption is very strong. And where we are a bit light in terms of exposure today is on the telecom, for example, in India. We have a bit this positioning. We have a preference for large cap versus small and mid cap as of today as well.
Okay. How much of your allocation is also a function of MSCI? Because in MSCI, the China weightage is very high, India weightage is low.
I think it depends on the mandate, it depends on the clients as well. But when we have the possibility to have freedom, we try to get rid a bit of the market capitalization and of indexes as well. I think it's important when you look at it to try to see opportunities. And if the opportunities is smaller in terms of market cap, it still deserves some allocation. So we look at it more in terms of risk budget allocation, in terms of volatility allocation, in terms of conviction we have. So typically we have been underweight on Max 7 for a long time. Okay. This has been costly, but we are fine with that. It's a strong conviction. And over the last 8 weeks, we have been making up a portion of the losses that we had over the last quarter, for example. So we are conviction manager. And when we feel that the market capitalization is too extreme in one area, we are happy to be underweight and to try to find the other pocket that is a bit disregarded, neglected, and that has good fundamental, actually.
Okay. I'll take the clock back before I take it forward. We are in 2025, but if we were, let's say, sitting and discussing your India view in 2020 and today, what has changed in your total commitment? I mean, do you still like the same stocks? Have you added new stocks? Have you started liking new entrepreneurs? How has your portfolio positioning in India changed in the last 5 years? I'm not talking about the commitment levels, not overweight, underweight, but in terms of theme, ideas, and sectors.
So first, I will answer on the commitment. I think our exposure to India has been increasing massively over the last 5 years. Then the way we have been expressing our views has been, in terms of stocks, has been changing as well a lot. Because you have new stories in India. You have new development of sub-industries. You have new smaller companies that have been progressively climbing into larger companies. And more generally, I think in terms of macro stability, India has been now, for us, we are perceiving India and the way RBI has been communicating as getting more and more reliable. Foreign exchange reserve has been increasing. Inflation, they have been waiting before cutting rates, waiting more than other central banks. They were feeling a bit under pressure, but they kept steady. And now they have been able to cut, and it's right time. So in general, the macro stability has been a strong positive in our view, and the strong innovation. What's missing in our view, or what can be improved, is the manufacturing capability of India to become a real alternative in the China Plus One policy. China Plus One policy, US companies have been allocating here, Japanese companies have been allocating here, but mostly via services. On the manufacturing, I think there is a lot of things to do in India, where India can actually become a larger share of global manufacturing export. Today, India on manufacturing is progressing, but still from a low level. So I think we are willing to see a bit more manufacturing stock coming in, and some policies as well to favor this from a fiscal point of view.
There are two factors which don't support India for foreign investor. One is currency. The natural direction of the currency is 3%, 4%, 2%. It declines on an aggregate basis. Second is taxes. If foreigners make money here, they pay taxes. Is that a deterrent when you look at India versus China? Does India lose out because of these two factors?
No, I don't think so, but I think it's a concern. So I think investors are looking at it, and portfolio managers like us are looking at it, because you have to pay a lot of tax on the coupon you're getting on India bonds, and you have to pay a lot of tax on the capital gain you're making on India equity. And this is definitely a negative when you're building up your investment case, because when you have today in the company we have expected earnings for next 12 months in India of 13.5%. We are not far from the consensus. The consensus has been revised down. But then when you're looking into potential depreciation from the rupiah, and then you're factoring in a bit of tax as well on your capital gain, it's becoming less of a super buy story, because you may have mid-single-digit P&L then over the long term. So one way of doing it, some investors have been trying to do it. We don't think it's an appropriate one, because it's lack of liquidity, is to go via GDR. So stocks, Indian stock quoted in London, you don't have a lot of liquidity there, and on top of it, you don't have small, mid-cap, and interesting business models that are developing. On the bond side, what we have been doing extensively is as well to invest in India SSA. So India, but denominated in dollar, where you have a slightly lower liquidity, but a better rating, sometimes better ESG rating as well. So we have been trying to tap into India bonds without committing into India bonds too much.
Good. Okay. We're just enjoying a conversation so much that I've lost track of time, but there is a time which we need to honor. I mean,
of course.
I've been sending my appointment with you. So I'll just summarize with a few last questions. And I'll use the liberty of time here, which is what do you like in the short term, which is less than a year? What do you like in the medium term, which is 1 to 3 years? And what do you like in the 5-year plus, which is the long term? What are your super buys? Short term, medium term, long term?
It's not an easy one because I know from where I'm coming from, so I have behavioral biases. Now, I think short term, we do believe the China rally can become sustainable, and we do believe that the valuation there, despite the re-rating we've seen, is still very, very light. So we are back at 10-year average in terms of PE across all the indexes. So very short term, China can make a good profit. Over the medium term, India is a structural story, and we like this. Over the very long term, I think we will have to diversify further portfolios. So getting further away from the MSCI weight to make sure that you are taking profit across the years and you are reallocating to better areas that have not performed yet, or you will be mean reverting every time. So I think this is more the long-term strategic story and it means having a bit less of US going forward.
Okay, that's the word coming in from Florian Neto of Amundi.
If you like this video, then like, share and subscribe to ET Now.